Risk versus return. Complete narration. From fundamental concepts to real-world application. The fundamental trade-off. Welcome. Today we're exploring one of the most fundamental concepts in investing, the relationship between risk and return. Every investment you make carries a certain amount of risk to achieve an anticipated return. This isn't just financial theory. It's the reality that governs all investment decisions. Generally, high-risk investments provide the potential for better financial returns over time, but they also come with a higher risk of loss. Conversely, lower-risk investments typically offer more modest returns. The key to successful investing isn't avoiding risk altogether. That would mean settling for minimal returns. Instead, it's about understanding your personal risk tolerance and building a portfolio that balances different levels of risk appropriately. Understanding volatility. Now let's talk about how we measure risk. The most common way is through volatility. Volatility describes the size and frequency of changes in your investment's value over time. Investments that experience large or frequent price swings are considered more volatile and therefore riskier. Visual cue. Display chart comparing the smooth line of bonds versus the jagged line of stocks. For example, stocks tend to have much larger and more frequent value changes than bonds. That's why stocks are generally considered riskier investments. It's important to remember that volatility poses the greatest risk over shorter time frames. Historically, markets tend to smooth out over longer periods, which is why time horizon is such a critical factor in investment planning. Asset classes and diversification. With millions of investment choices available, how do we make sense of it all? This is where asset classes come in. Asset classes group investments with similar risk and return characteristics. Common examples include U.S. large-cap stocks, U.S. small-cap stocks, and fixed income investments like bonds. Diversification, spreading your investments across different asset classes, is the key to managing risk. It's the classic, don't put all your eggs in one basket approach. By combining assets with different risk levels that don't move in perfect sync, you can potentially reduce your portfolio's overall volatility while still positioning for growth. Benchmarks and performance measurement. How do you know if your investments are performing well? This is where benchmarks become essential. A benchmark is a standard used to measure investment performance. Common examples include the S&P 500 for U.S. large companies or the MSCI EAFE for international markets. Schwab and other firms create model portfolios at different risk levels that serve as custom benchmarks. These help you answer a critical question. Are you achieving satisfactory returns for the amount of risk you're taking? Without appropriate benchmarks, you might celebrate a 10% return without realizing the market returned 15% with similar risk, or worry about a 5% loss when the market dropped 10%. Example, portfolio analysis. Now let's examine a real-world example that brings these concepts to life. Cumulative return, December 2016 to September 2025. 31.12%. Annualized return. This portfolio achieved a remarkable 963.94% cumulative return over nearly 9 years, which translates to an annualized return of 31.12%. But numbers in isolation can be misleading. The real question is, how does this performance compare to taking a different level of risk? As you can see, this portfolio significantly outperformed all major market benchmarks. It beat the Nasdaq by over 12 percentage points annually and the S&P 500 by nearly 16 points. This exceptional performance didn't come without cost. To achieve these returns, the investor likely accepted substantial volatility and potentially experienced significant drawdowns during market corrections. The key takeaway from this example is that superior returns typically require accepting higher risk. This portfolio strategy clearly involved above-average risk-taking, which paid off handsomely during this period. Conclusion and key lessons. So what are the key lessons we can draw from both the theory and this real-world example? First, understand that risk and return are inseparable partners in investing. You cannot expect market-beating returns without accepting above-average risk. Second, know your personal risk tolerance.
The portfolio we examined delivered exceptional results, but its volatility would have been unbearable for many investors during downturns. Third, always use appropriate benchmarks. Without comparing to the NASDAQ or S&P 500, you might not realize how much risk was actually taken to achieve those returns. Finally, remember that past performance never guarantees future results. While this strategy worked brilliantly from 2016 to 2025, different market conditions may require different approaches. The ultimate goal isn't to eliminate risk, but to understand it, measure it, and ensure you're being adequately compensated for taking it. Thank you.